Excellent. Okay, so let's get into BCE here. BCE Inc., one of the largest companies in the Canadian market, telecom, the largest telecom player. It's trading right now at a stock price of $38, 37 billion market cap company, and a huge yield of 9%. I mean, we get a lot of questions about BCE because of that yield. It's not often that you see a yield that high on such a large company in the Canadian market. So what do they do? Well, they're a wireless internet service provider. They are one of the big three. So there's BCE, Rogers, and TELUS. BCE has roughly 10 million customers, and they make up about 30% of the market. So think of what telecom is widely considered to be one of the more stable sectors in the Canadian market. And a lot of people go to these stable sectors like utility telecom to get a yield that they, or a dividend that they believe that they can rely on. So when people see this 9% yield, they certainly have questions about whether or not this is sustainable and if this is a monumental opportunity to purchase shares of BCE. We actually had coverage on BCE many years ago in our income research as one of our original recommendations, and it performed very well back then. So well, in fact, that the valuation got expensive due to share price appreciation. And at a point, we decided to sell and move on to some other names. But what has been going on recently with BCE? Well, the stock price took a major hit on November the 4th. In a single day, it dropped 10%. And this is after the company announced that it plans to acquire a Ziply Fiber for approximately 5 billion Canadian, and in an effort to expand into the US market. So after that announcement was made, the stock price declines 10% on a single day. And since then, it's continued to decline. So it's now down about 14% since the announcement was made. Clearly, this is an indication that the market is not particularly enthused about something. So we'll take a look and try and figure out what this is. But this wasn't the beginning of the company's problems. BCE has been performing, not very well over the last couple of years here, really since the interest rate tightening began in 2022. And this makes a lot of sense because given that it's a large, lower growth dividend payer, it's typically going to have an inverse relationship to interest rates. So interest rates hit these large cap dividend payers more so than they typically do other companies like growth stocks. And the reason for this is because a lot of people will go to BCE for the nice dividend, but if they can get a nice income yield now from a GIC, then they start to potentially look elsewhere. So the company's really been trending downward over this period since the tightening began. But now that this is reversing and interest rates are starting to go down, we still haven't seen any recovery in this company like we have in a lot of other sectors like utilities and REITs. Right now, BCE's stock is actually trading at about a 13-year low. So any investors that have been in this stock for the past decade plus, the only return they've really been receiving is with the dividend. So I'm going to just take a look at what the company is expecting in terms of financial performance for 2024 to kind of get some clarity on why the stock price has not been performing better. And what I'm seeing here, and this has really been the case with BCE for the last couple of years, is lackluster financial performance. So we'll take a look at the revenue growth. Even last year, revenue growth was not very strong, only 2.1%. But this year, they're actually expecting a decline in revenue of about 1.5%. And they actually had to update their guidance when they just recently released their Q3 results. Previous to that, they were estimating 0% to 4% positive revenue growth, and now they're looking at a slight decline in revenue. So really not great news there. Adjusted EBITDA growth last year, 2.1%. This year, they're estimating between 1.5 and 4.5. So that's 3% at the midpoint, comparable to last year. But then we go down to adjusted earnings per share. That was down last year, and it's expected to be down again this year, down between -2%, -7%. And the same goes with free cash flow. It was up a little bit last year, about flat. but the free cash flow is expected to decline anywhere between -3% and -11% this year. So we're really not expecting to see a great rebound in the financial performance in 2024. And then looking at 2025, right now we don't have guidance, we don't have any forecasts out, but it's still looking fairly lackluster, even if growth resumes. What we would be expecting, even in a good year for BCE, would be mid single digit growth, based on what they've been producing recently. But in spite of this, they have continued to grow their common share dividend, and some people will think that that's a good thing. We do not necessarily. Certainly, if you're just going through 1 or 2 years of negative growth and that's expected to reverse, I like the consistent dividend growth strategy. So maintaining that dividend growth is a fine thing to do. But the problem with BCE is when we take these growth projections for 2024 and we actually calculate what the expected earnings per share and the free cash flow are, we can see that the payout ratio is significantly above 100%. And that doesn't matter if you're calculating the payout ratio based on adjusted earnings per share or if you're calculating it based on free cash flow. So 130% payout ratio based on adjusted EPS, considering the company's guidance, and 125% based on free cash flow. So this is not a sustainable situation. A payout ratio above 100% basically means the company is paying out more in dividends than it's actually earning. And there's eventually companies have to reverse course on this type of a strategy. We would really see a reasonable payout ratio for a company like BCE, ideally to be in the 70 to 80% range. 80 to 90% would be okay, but even that, the margin of safety is getting low. But significantly above 100%, like what we're seeing for BCE, is not a sustainable situation. So when we look at that 9% yield, a significant portion of that dividend to produce that yield is being financed either with debt or with share offerings. I'd also like to just take a quick look at the balance sheet as well. Balance sheet, debt leverage. This is really the foundation upon which the business is built. If you have too much debt, that adds a lot of risk. It really limits your ability to invest in the business. It limits your ability to go out and acquire other businesses as well. So BCE has total debt of about $40 billion. They're estimating adjusted EBITDA in the range of about 11 billion. So that would be a debt to EBITDA multiple of 3.7 times. Now, normally I would not think that this is extremely excessive for a large company in a stable sector like BCE, but I would certainly say that debt to EBITDA of 3.7 times is fully leveraged. There's really not a lot of space for that leverage ratio to go up. So you have a payout ratio that is well above 100%, a debt to EBITDA multiple that is basically as high as we would like to see it. We'd even ideally like to see it a little bit lower. There's just really not a lot of flexibility for BCE right now. Now, they did announce that intent to acquire Ziply Fiber. This is a leading fiber internet provider in the Pacific Northwest of the United States. So $5 billion is the acquisition price. And what they're looking to do is to grow into the US market. And this acquisition is expected to close in the second half of next year. Now, in order to finance this acquisition, what they're doing is they've announced the sale of their minority stake in Maple Leaf Sports. So this is part of the major asset there would be the Toronto Maple Leafs. They have a minority stake in this. This is a non-core asset, meaning it's not part of the main business focus, which is telecom. So they've decided to divest this for 4.7 billion, and then they're going to sell that to Rogers Communications, and then they're going to use that money to purchase Ziply Fiber, assuming that all of the approvals are met. And the sale of their interest in MLSE is also expected to close in mid 2025. So at the very least, they are able to sell a non-core asset to buy something that is more core to their business. So it doesn't seem like they're going to have to increase debt very much in order to make this acquisition happen. So that's a good thing, because as I said, the leverage ratio was already high. And I also agree with them doing this. I mean, the market likes businesses that are very focused on a specific market or industry. The market is usually less enthusiastic about companies that kind of have, assets in a variety of different industries and like a lot of non-core things that they're doing. Investors like focus. So this is probably a good move. I don't know much about Ziply Fiber. It's not a situation where I'm really going to do a lot of in-depth research on it if I'm not close to recommending BCE anyways, which I am not. So this is just a situation we would have to see how it plays out. Certainly in the United States, there's going to be more competition, but it could alleviate the problem that they have where in the Canadian market, there's just not a lot of growth in telecom. So what is our take? Some of the good things that I can say about BCE, we love essential assets, and telecom is absolutely essential. BCE, we do not believe is going anywhere. It is trading at a relatively low valuation, about 12 times earnings right now. So we would consider that, relatively low, and it has that high yield. But the problem is, just really weak growth, not great share price performance, poor shareholder returns, and that payout ratio just being unsustainable. Now, I don't necessarily believe that BCE is going to have to cut their payout ratio right away. They can probably continue to finance it with cash flow that does not come from operations. We just think that there's going to be a point where if they cannot grow into that payout ratio, they are going to have to cut it, or they're just going to have to increase their debt too much. So we like companies that are able to maintain and grow their dividends with internal free cash flow and not be reliant on outside financing. So while we certainly like a high yield and we like dividend growth, the payout ratio is not sustainable. So that's just a no-go for us. Now, lower interest rates will help BCE. I do believe that with the acquisition, they're going to put a pause on the dividend growth. So maybe that will give them an opportunity to catch up, for earnings to catch up with the dividend. But until that happens, we're not going to speculate on, where interest rates are going from here or how that's going to affect the company. There is risk in this acquisition that they're doing, even though it may be ultimately a good move for them. So there's just too many unknowns for the company right now. I would say, kind of as a speculative rebound story, there could be an argument for a small position, but it's not what I would consider to be a solid, sustainable dividend growth stock, the likes of which we would like to invest in. So we're on the sidelines on BCE right now, and we'll just monitor the company and we'll see how things go.
Yeah, I mean, it is crazy how if you look at the performance of BCE over the past 10 years, and like this is a stock that you see all over BNN, you see, portfolio managers all across the country, um, putting in portfolios being a big part of it. And, it's literally down from where it was 10 years ago. There's been a good dividend yield there, but, your total return is getting crushed by so many other companies, the index, the U.S. market index, the Canadian index over that 10-year period. And the company has not performed in and driven portfolios. I mean, it's funny because I had a client call this morning and we are going over 10 stocks that were in there. And these are 10 stocks that you probably don't find in the majority of Canadian portfolios. They come from our research. And, all 10 of those, when I look now, would have significantly outperformed BCE over the past 10 years. So, you hear about BCE a lot, not necessarily the best stock to have been over that period. And that ownership they have in MLSE, I do agree they should, focus on what you do. I mean, MLSE basically owns every Toronto-based sports team. They own like the Leafs, the Raptors, the Toronto FC, the Argonauts, the AHL team, and the Raptors G League team, and on a bunch of other teams as well. They own everything. It's not really core to what BCE was doing. They made money off of it, so good on them for that. From the purchase price, as far as I understand, significant. But it's not core. Do what you do best. Maybe they can start to grow in that area.